Hi, I am Stephen Clark. After exploding above $5,000 earlier this year, the price suddenly dropped hard, falling toward the $4,600 range. And now, it's sitting in a very tight zone around $4,650 to $4,690 as of April 6th. So what changed? The answer is not simple. This entire move is being driven by one thing: the escalating tension in the Middle East involving Iran, the United States, and Israel. But here's where it gets even more interesting. Right now, behind the scenes, ceasefire talks are actively happening, and that changes everything. Because depending on what happens next, gold could either collapse further or explode toward new highs again. In this video, we're breaking down exactly what's happening, what smart money is watching, and most importantly, what happens next if a ceasefire actually happens. Stay with me, because this could be one of the most important turning points for gold in 2026. Let's first understand what just happened to gold. Over the past month, we've seen one of the sharpest pullbacks in years. Gold went from extreme strength into a sudden correction phase, wiping out a large portion of its gains. And this wasn't random. When the Middle East conflict intensified, oil prices surged rapidly. That triggered a chain reaction: higher inflation expectations, rising bond yields, and a stronger US dollar. And all three of these are negative for gold in the short term. So even though gold is considered a safe haven, the inflation shock actually forced markets to price in higher for longer interest rates, and that pushed gold lower. Right now, gold is stabilizing, not trending strongly up or down. It's what many analysts call a digestion phase after a parabolic move. But this stability is fragile, because the next move depends heavily on one key catalyst. That key catalyst is simple: what happens in the Middle East next? Right now, multiple countries, including Egypt, Pakistan, and Turkey, are trying to push forward a ceasefire proposal. The goal? A temporary 45-day ceasefire and reopening of critical trade routes like the Strait of Hormuz. Now, why does this matter for gold? Because gold is heavily influenced by fear. When uncertainty rises, gold goes up. When tensions ease, gold often pulls back. And we've already seen this pattern. Even small rumors of a ceasefire earlier triggered volatility and short-term drops in gold prices. So imagine what happens if a real agreement is reached. That's where things get interesting. If a ceasefire is officially announced, the first reaction in gold is likely very clear: a drop. Why? Because safe haven demand will fade quickly, markets will breathe, fear will decrease, and traders who rushed into gold for protection may start taking profits. This kind of reaction is usually fast and emotional. We could see gold test lower support zones, possibly in the $4,400 to $4,600 range. But here's the twist that most people miss: that drop may not last. Because once the initial panic fades, the market will shift focus to something much bigger: interest rates. And this is where gold could flip direction very aggressively. Now let's talk about what happens after that initial reaction. If a ceasefire holds, oil prices likely stabilize or fall. That reduces inflation pressure. And when inflation pressure drops, central banks, especially the Federal Reserve, get room to start cutting interest rates. This is critical, because lower interest rates weaken the US dollar and reduce bond yields. And both of these are extremely bullish for gold. So in this scenario, gold could first dip, and then begin a strong recovery. Some analysts are already suggesting that if rate cut expectations return, gold could move back toward $5,000 and beyond later in 2026. So the real question is not just whether gold drops, it's whether that drop becomes the biggest buying opportunity of the year. Move forward, because the next part gets even more important. Now let's break this into clear scenarios, because this is exactly how smart money is thinking right now. There are only two real paths from here. Scenario 1. No ceasefire. Conflict continues or escalates. In this case, most people expect gold to rise because of fear, but that's not always how the market reacts. If the conflict keeps pushing oil prices higher, inflation stays elevated, and that forces central banks to delay rate cuts or even stay restrictive longer. That's bearish for gold. So instead of rallying, gold could actually struggle and even drop further toward the $4,000, $4,300 range. This is the scenario where gold becomes trapped between fear and high interest rates. And historically, interest rates often win in the short term. Now scenario 2, and this is the one the market is watching very closely: a confirmed ceasefire agreement. At first, gold likely drops. That's the emotional reaction. Traders exit safe haven positions quickly. But then the narrative changes. Lower geopolitical tension, lower oil prices, lower inflation expectations. And suddenly, markets start pricing in rate cuts again. This is where things can flip fast. Because when real yields start falling, gold doesn't just recover, it often accelerates. In this setup, gold could move back toward $4,800, $5,000, and potentially even higher if momentum builds. This is why some institutional players are not panicking right now. They're waiting. And this brings us to something most retail traders completely ignore. What are central banks doing right now? Even during this recent pullback, central bank demand for gold has not disappeared. Countries continue to accumulate gold as part of long-term diversification strategies, especially in a world where trust in fiat currencies is slowly shifting. This is a structural force. It doesn't react to short-term headlines. So while traders are focused on ceasefire news and daily price swings, central banks are quietly building positions. And this creates a strong, long-term floor under the gold market, which means, even if gold dips short-term, the bigger trend may still be intact. Now let's talk about positioning, because this is where the real edge comes in. Right now, the market is divided. Short-term traders are cautious. Volatility has shaken confidence. Many are waiting on the sidelines. But longer-term investors are starting to look at this differently. They see this pullback not as weakness, but as a reset after an overheated rally, a cooling phase. And historically, these phases often come before the next major move higher, especially when macro conditions, like potential rate cuts, are shifting in gold's favor. So instead of chasing price, smart money is watching key levels and waiting for confirmation. They're not reacting emotionally, they're preparing. So where does this leave gold right now? At a crossroads. On one side, geopolitical uncertainty, inflation pressure, and interest rate risk. On the other, potential ceasefire, falling inflation expectations, and a shift toward easier monetary policy. And the next move depends on which side wins. Short-term, volatility is almost guaranteed. But medium to long-term, the setup is becoming very interesting. Because if the market transitions from fear of inflation to expectations of rate cuts, that's when gold historically performs its best. Move forward, because in the next part, we'll break down exact price targets, key levels, and what you should be watching next. Let's talk numbers, because this is where everything becomes real. Right now, gold is holding in a critical range between $4,600 and $4,700. This zone is not random. It's acting as a major support area after the recent correction. If gold holds here, it signals that buyers are still active in defending the trend. But if this level breaks decisively, then the next downside targets come into play. We're looking at potential moves toward $4,400, and in a more extreme case, even the $4,000 to $4,200 zone. That's where strong historical demand could step back in. So this range right now is a decision point. Hold, and gold stabilizes. Break, and volatility expands quickly. Now on the upside, the picture becomes very interesting. If gold starts reclaiming momentum, especially on positive ceasefire developments, the first key level to watch is $4,800. This is where previous resistance sits. A clean break above that, and the psychology shifts instantly. Because above $4,800, the path toward $5,000 opens up again. And once gold approaches that level, momentum traders, institutions, and even retail investors tend to pile in aggressively. That's how explosive moves begin. And if macro conditions align, especially with rate cut expectations returning, gold doesn't just test highs, it can overshoot them. Now let's connect all of this into a realistic timeline. Short term, the next 1 to 2 weeks. Everything depends on headlines. Any confirmed ceasefire news could trigger immediate volatility and a short-term drop, but that move could be fast and temporary. Medium term, over the next 1 to 3 months, the focus shifts to central banks and interest rates. If inflation cools and rate cuts come back into the conversation, that's where gold builds momentum again. And then long-term, looking into late 2026, many projections still point towards significantly higher prices. Some forecasts are targeting $5,000 to $6,000 plus if macro trends continue aligning. So what should you actually be watching right now? There are 3 key signals. First, ceasefire confirmation or breakdown. This is the immediate trigger for short-term direction. Second, oil prices. If oil drops, inflation pressure eases, and that supports gold later. Third, Federal Reserve expectations. If markets start pricing in rate cuts again, that's one of the strongest bullish signals for gold. These three factors are connected, and right now, they're all moving at the same time. That's why gold is not trending cleanly. It's reacting to a complex mix of forces. Now here's the big takeaway most people are missing. Gold is not just reacting to fear anymore. It's transitioning into a new phase. Earlier, gold rallied aggressively because of uncertainty and macro stress. Now the next phase depends on policy shifts, and this is where the opportunity is. Because markets move ahead of reality. They don't wait for rate cuts to happen. They move when expectations change. So if the narrative shifts toward easing conditions, gold could start moving before most people even realize what's happening. Move forward, because in the final part, we're going to bring everything together and answer the most important question. So now we arrive at the most important question. What happens next? Right now, gold is not in a clear trend. It's in a waiting phase, a decision phase. The market is watching headlines, watching central banks, and positioning quietly behind the scenes. And this is exactly the type of environment where the next big move begins. Because once direction is confirmed, the move is usually fast. Not slow, not gradual, fast. And if you're not prepared before that move starts, you're already late. Let's simplify everything into one clear idea. Gold is currently caught between two powerful forces. On one side, geopolitical tension and inflation pressure, which can keep interest rates higher. On the other, potential ceasefire and falling inflation, which opens the door for rate cuts. And whichever side wins, that's the direction gold will follow next. This is not noise. This is a macro turning point, and these moments don't happen often. Now here's the key insight smart investors understand. The biggest opportunities don't come when everything is clear. They come when things are uncertain. Right now, most people are confused. Some are bearish, some are waiting, some are completely out of the market. But this is exactly when positioning begins. Not when gold is already breaking new highs, but when it's consolidating, testing levels, and shaking out weak hands. Because by the time the breakout becomes obvious, the easy move is already gone. So if you step back and look at the bigger picture, gold is pulled back after a massive run. It's holding a key zone. Central banks are still buying, and macro conditions are slowly shifting toward a potential easing environment. That's not a collapse setup. That's a setup for a decision. And depending on how the next few weeks play out, this could define the rest of 2026 for gold. A drop first, then a rally, or continued pressure before a deeper reset. Either way, the move is coming. Now I want to hear from you. Do you think gold drops below $4,400 first? Or are we heading straight back toward $5,000? Comment your prediction below. And if you want clear, no-noise breakdowns of gold and silver, explained in a way that actually makes sense, gold is currently at a critical turning point, trading around the $4,600 to $4,700 range after a sharp correction from earlier highs above $5,000. This recent volatility has been driven by a complex mix of factors, primarily the Middle East conflict involving Iran, the US, and Israel, which pushed oil prices higher, increased inflation expectations, and strengthened the US dollar. As a result, markets began pricing in higher-for-longer interest rates, putting short-term pressure on gold despite its safe haven appeal. Now, everything depends on one key catalyst: a potential ceasefire. No ceasefire, continued conflict. Oil prices remain elevated. Inflation stays high. Interest rates remain restrictive. Gold may struggle or drop toward $4,000, $4,300. Ceasefire happens. Initial drop in gold. Safe haven demand fades. Oil prices stabilize or fall. Inflation pressure decreases. Rate cut expectations return. Gold could rally back toward $5,000 plus. Ceasefire developments. Main trigger. Oil prices. Inflation signal. Federal Reserve rate expectations. US dollar and bond yields. Central bank gold buying. Long-term support. Short-term. Volatility and uncertainty. Medium-term. Strong potential if rate cuts return. Long-term. 2026. Bullish structure remains intact. Many projections still suggest a $5,000 to $6,000 plus range if macro conditions align. Gold is no longer just reacting to fear. It's transitioning into a policy-driven phase. The next major move will likely come not from headlines alone, but from how markets interpret inflation and interest rates after a ceasefire. Make sure you subscribe to the Stephen Clark, because we cover what matters, not just headlines, but what's really driving the market.